Here's a question most people never think to ask. When you deposit money into a bank, where does it actually go? Not in some abstract, philosophical sense. Physically, where is it? The honest answer would surprise you. It's gone. The second you hand over your paycheck or tap your phone at the ATM, that money is no longer yours in any meaningful sense. The bank has it, and they are doing things with it that most people would find genuinely startling. Today, I want to pull back the curtain on one of the most sophisticated and quietly powerful business models in human history. Not to scare you, not to make you distrust the system, but because understanding how banks actually make money is one of the most practical pieces of financial education you can get, and almost nobody ever explains it clearly. By the time this video is over, you'll see your bank account differently. And if you're the kind of person who thinks carefully about where your money goes, that new perspective is going to be worth a lot. Let's start with the most fundamental mechanism in banking, the one that everything else is built on. It's called the interest rate spread, and it is breathtakingly simple once you see it. When you deposit money, the bank pays you for that privilege. Maybe 2%, maybe 4%, depending on the account and the era. That interest payment is real. It shows up in your account every month. But what the bank is actually doing is borrowing your money. You are, without realizing it, a lender. And like any lender, you get paid for the use of your capital. Now here is where it gets interesting. The bank takes your deposit, your loan to them, and immediately turns around and lends it to someone else. A home buyer who needs a mortgage, a small business owner who needs capital, a student financing a degree. And when they lend that money, they charge significantly more than they paid you. If they're paying you 4%, they might be charging the mortgage borrower 7 or 8. They might be charging the credit card holder 18 or 20. Think about what that means at scale. A bank with $100 billion in deposits, paying out 4% and collecting 8%, is pocketing 4% on $100 billion every single year. That's $4 billion in annual revenue, just from that one mechanism, before any other fees or investments. The spread seems small, the scale makes it enormous. But wait, it gets stranger. You might be thinking, fine, the bank borrows at 4 and lends at 8. But surely they can only lend out what people have deposited, right? They can't lend more than they have. Wrong. And this is the part most people never learn in school. Banks operate under what's called Fractional Reserve Banking. The central bank, in America, that's the Federal Reserve, sets a reserve requirement, historically around 10%. What that means is that for every $100 deposited, the bank only needs to keep $10 in reserve. The other 90 can be lent out. Now here's where it gets recursive and a little mind-bending. When the bank lends out those $90 to, say, a small business owner, that business owner spends the money. It goes to pay an employee or a supplier and eventually lands in someone else's bank account. Now that bank has $90 in new deposits and can lend out 81, and so on, cascading through the system until, theoretically, the original $100 has supported close to $1,000 in total lending activity across the economy. Banks are not just intermediaries. They are, in a very real sense, creators of purchasing power. That's not a conspiracy. It's a feature, not a bug. It's how credit expands to meet economic growth. But understanding it changes how you think about what a bank actually is. It is not a warehouse. It is an engine. Interest income from lending is the core business, but banks have layered dozens of other revenue streams on top of it, most of which you barely notice because they're designed to feel invisible. Every time you swipe a credit card, the merchant on the other side pays an interchange fee, typically between 1% and 3% of the transaction. You don't see it, The merchant absorbs it as a cost of doing business, but Visa, MasterCard, and the issuing bank, often the same institution, split that fee. Multiply that by billions of card swipes per day, globally, and you begin to understand why major banks spend so aggressively to put their credit cards in your wallet. Then there are the fees that directly hit consumers. ATM fees, monthly maintenance charges, overdraft penalties, wire transfer fees, foreign transaction fees, late payment charges. Each one seems like a minor administrative cost. Cumulatively, they generate tens of billions of dollars annually across the banking sector. JP Chase alone collected more than $3 billion in overdraft and service fees in a single recent year. Banks have also built massive fee businesses from services most consumers never touch directly: wealth management, investment banking, foreign exchange trading, derivatives, underwriting corporate debt. These are the businesses that dominate the revenue mix at the largest institutions. When Goldman Sachs reports a blockbuster quarter, it's usually not because your savings account made them money. It's because they executed a billion-dollar merger or managed a massive bond offering for a corporation you've never heard of. Here is something counterintuitive. Banks don't actually try to avoid risk. They try to price it correctly. That distinction matters enormously. When you apply for a loan, what the bank is really doing is running an analysis to determine how much risk you represent, and then deciding whether the interest rate they can charge you is sufficient compensation for taking that risk. A borrower with an excellent credit score, stable income, and significant assets represents low risk, so the bank can offer a competitive rate and still profit. A borrower with a spotty credit history represents higher risk, so the bank either charges a much higher rate or declines the application entirely. The mechanism behind this is the credit score, a numerical summary of your borrowing behavior, payment history, debt load, and credit age. It is, from the bank's perspective, a risk pricing tool, and they've refined it over decades into something remarkably predictive. Default rates on loans across different credit score bands are well documented and remarkably consistent, which allows banks to extend credit at scale without individually analyzing millions of customers from scratch. But credit scoring is just the retail version of something banks do at every level. When they invest in government bonds or corporate debt, they're assessing sovereign risk, corporate risk, interest rate risk, liquidity risk. The entire institution is, at its core, a sophisticated risk management operation that happens to be structured as a financial intermediary. The profit comes from being better at pricing and managing risk than the average participant in the market. Understanding how banks make money would be incomplete without understanding how they can lose it, catastrophically, and in ways that drag the broader economy with them. The fractional reserve model works beautifully in normal times when defaults are predictable and manageable. But it has a structural vulnerability. If too many loans go bad at once, the bank doesn't just lose profitability. It can lose solvency, and because deposits are a liability, money the bank owes to you, a bank that can't meet its obligations is a bank in crisis. This is what happened in 2008. The housing market collapse didn't just hit homeowners. It hit the complex web of mortgage-backed securities that banks had used to repackage and redistribute mortgage risk throughout the financial system. When housing prices fell and defaults spiked, institutions that were supposed to be insulated from risk discovered they were exposed in ways their own models hadn't anticipated. The cascading failures that followed are still shaping economic policy today. This asymmetry is why banking regulation exists and why it's so contentious. Regulators want capital buffers, liquidity requirements, and restrictions on risk-taking. Banks want flexibility to deploy capital and maximize returns. The tension between those two forces, and who wins in any given political era, shapes the financial landscape most of us live inside without ever thinking about it. So why does any of this matter if you're not a banker, an investor, or a financial regulator? Because the system we've just described touches every major financial decision you'll ever make. When you choose a bank, you're choosing a partner whose business model depends on deploying your money. A bank that offers you a higher savings rate is likely doing so because they have profitable lending opportunities they need capital to fund. A bank that offers you rock-bottom rates on deposits is essentially telling you that they don't need your money that badly, or that they've found cheaper ways to fund themselves. Knowing this helps you negotiate, compare, and choose more deliberately. When you take on debt, understanding the interest rate spread should change how you think about urgency. That mortgage at 7%, that car loan at 9%, that credit card at 22%. These aren't just numbers a computer spat out. They're the bank's assessment of your risk profile and their required compensation. Improving that profile, paying down debt, building savings, keeping credit utilization low, directly reduces what you pay to access capital for the rest of your life. And when the news cycle is full of banking crises, interest rate decisions, or regulatory debates, you now have a mental model for what's actually at stake. The Federal Reserve raising rates doesn't just affect mortgage payments in the abstract. It changes the entire spread environment, compressing margins, slowing lending, reshaping where banks can profitably deploy capital. Those decisions ripple into hiring, investment, and the economic conditions that determine your own opportunities. Banks are not monolithic villains. They're not passive warehouses either. They're engineered systems for moving risk through time and across populations, and doing so profitably. Understanding how the engine works doesn't make you cynical about the system. It makes you a better participant in it. And in a world where financial literacy is increasingly the difference between building wealth and giving it away slowly, that understanding is genuinely valuable. Take it with you.